Hello and welcome to the program. I am Bisi Adibaya. Coming up today, UK economic growth slows again in October. Zimbabwe's inflation rate eases to 401.66% in November. Plus, International Monetary Fund projects 6.5% growth for Cote d'Ivoire's economy in 2021. Well, let's see up today's show as usual with market numbers. And here in Africa, the markets in Nigeria and South Africa were negative at intraday, posting declines of 0.32% and 0.24% each. Egypt's EGX30 managed to eke out 0.03%, while Kenya closed marginally positive on Wednesday. Over in the Middle East, investor sentiments were mixed at intraday as the Abu Dhabi index rose 0.6%, while Dubai's main index advanced 0.28%. Elsewhere in the region, the Qatari index shaved off 0.7%, while Saudi Arabia's market was 0.25% lower at intraday. And European stocks were muted today as markets struck the parlous state of Brexit trade deal talks between the UK and the EU this week. Investors are also awaiting the latest policy decisions from the ECB. Let's talk to Chelsea Delany for more details. Good afternoon, Chelsea. The European Central Bank is just minutes away from announcing its latest policy decision. What are the markets expecting?
Well, markets are essentially flat here in Frankfurt, but expectations are quite high among investors that we will see further support coming from the European Central Bank today. Most analysts and economists expect the ECB to come forward and announce about 500 billion euros more in bond buying. It's already got about 1.4 billion euros that it's been a package that it's been using to buy government and corporate bonds. That's really helped drive down interest rates for governments and companies and help them stay afloat throughout this pandemic. But as we're facing a second wave of infections and a second wave of lockdowns throughout Europe, there is a consensus that more help is needed and a really longer time frame is needed, because it is going to take much longer than many people had hoped for these economies to bounce back, especially now as it looks like the virus really isn't under control here in Europe. So the other thing that's expected from this meeting today is that the ECB will basically extend the timeline of this bond buying package, perhaps through the end of next year, perhaps even into 2022. As well, we are expecting the ECB to downgrade some of their forecast for the recovery in the European economy. And all of this just reflects that there still is a lot of economic uncertainty ahead, and more help, more support from these central banks is still needed.
But then, Chelsea, the economy could also soon be getting another dose of stimulus as EU leaders meet in Brussels today to try to hash out disagreements over the bloc's planned 750 billion euro coronavirus stimulus package. Can the EU leaders actually overcome their differences?
I think a lot of investors are waiting with bated breath to see what comes out of this EU summit over the next 2 days. The EU budget and coronavirus stimulus package has been held up for months by Hungary and Poland, who are basically blocking the passage of both the budget and the recovery fund because they have disagreed with one of the elements of that was attached to this recovery fund. It's called the so-called rule of law agreement. That means that if a country like Hungary or Poland basically kind of goes against democratic standards in Europe, that the EU would be able to potentially withhold some funds from them or punish them in other ways. Obviously, Hungary and Poland have been very unhappy about this and have been, as a result, blocking the passage of the entire stimulus bill. Germany has brokered some sort of compromise that everyone seems to be on board with, but hopefully they will be able to finally pass this package, because even though we are getting more support from the ECB, everyone really agrees, all economists, all monetary policy makers agree that we need also money coming from the fiscal side as well. So there really is a lot of pressure on these EU leaders in Brussels to finally reach this deal so that money can start flowing, hopefully at the beginning of next year.
And big tech continues to face attacks by regulators around the world. Now, the U.S. announced that it's suing Facebook on antitrust concerns, while France on Thursday fined Google and Amazon for data breaches. Walk us through all of these actions.
Well, I'll start with what's happening in the U.S., which is really a landmark case. This is the first antitrust lawsuit that's been brought against Facebook in the United States, even though they faced a lot of other investigations, particularly into their privacy and data usage. But this antitrust case is a much bigger attack from regulators. The FTC, the regulator in the U.S., actually says in the lawsuit that they want to break Facebook up. They want Facebook to divest or spin off WhatsApp and Instagram, which they bought back in 2012 and 2014. Whether Facebook will be successful and whether the FTC will be successful in forcing this breakup, that's really controversial. This is a bit of a test case for new rules against antitrust against tech companies. So there's a lot of questions over whether they actually will be successful, but it does come amid this big backlash to these tech companies, and it's not just the U.S. Here today, France and Europe also brought 2 fines against Amazon and Google for privacy violations related to ad trackers, as well. The antitrust antitrust authority here in Germany has announced that it's looking into Facebook for its VR glasses Oculus. So there really is a full force front coming after these tech giants, and really opposed to the way that they've been operating and the dominance that they've acquired over society.
Thank you, Chelsea. Do enjoy the rest of your day. Data from the Office for National Statistics shows the economy grew by just 0.4% in October, indicating economic recovery from the first wave of COVID-19 had almost come to a standstill. But let's get more details from Juliana Olainka. Good afternoon, Juliana. Could you unpack this latest GDP data for us?
Good afternoon, Bissy. Well, we saw strong gains in October in retail, education and car manufacturing. But on a whole, as you said, it appears as if the UK economy pretty much ground to a halt in the month of October. The growth was 0.4%, and that's significantly down from the 1.1% growth we saw in September. Though we have seen since April 6 months of consecutive growth, the growth is stalling. And I suppose what's led to more concerns and worries by the Treasury, by the government, is the fact that November, of course, saw the second lockdown, though we're not expecting the fallout to be as significant as it was in April. There are still some major concerns, and that's because Britain is a service-based economy. The OECD, the Paris-based think tank, has already predicted that by the end of the year, the British contraction is going to be much more severe than it would be with their other European counterparts, and that's causing major cause for concern. We know the economy is pretty fragile at the moment, and unemployment is still rising. And so even though we are seeing a slight bit of growth, that 0.1%, it's still not enough to take us away from the double dip recession, which is what a lot of people are expecting. Of course, this final quarter, the golden quarter, that it's all been talked about and hyped up about, was completely shut down because of the renewed restrictions across large swathes of the UK economy and that most significant lockdown in November. So far, not so good, and we are expecting November's numbers to point at a much more severe recovery.
Meanwhile, the Confederation of British Industry Forecast says that Britain's economy will bounce back next year from the COVID pandemic, but then a 5th year of weak business investment will delay a full recovery until the end of 2022. What does this mean?
Oh, what this means is that the CBI are really asking the government to give more incentives to British businesses. The Confederation of British Industry, they speak on behalf of about 200,000 businesses, many of them SMEs, and we know that SMEs are the engine of any decent economy, and they have really struggled, and it's been a couple of things. Obviously, COVID is one of them, but Brexit, can't have a crossover and not talk about Brexit, Bissy. That has been a major concern for British businesses. businesses. Since the 2016 referendum, 4.5 years ago now, British investment has pretty much stalled. I believe this year investment is down by about 19.1%, and it has maintained that same kind of stagnant pace since we decided to leave the EU. You know, we've only got a couple of weeks left, and still Boris Johnson and his government have no idea what kind of advice they can give to British businesses, and that's really what's stopping investment. A lot of people that wanted to invest in the City of London, wanted to invest and level up in areas outside of London, are not doing that now. They're doing it in mainland Europe, they're doing it in China, and that's really a major cause for concern for the CBI. So they have suggested that Chancellor Rishi Sunak, Boris Johnson do start speaking to businesses, do provide more information. And this is a major cause for concern, as we're just a couple of weeks left to the end of the transition period. Thousands, tens of thousands of businesses have no idea, absolutely no idea what they're going to do come January the 1st and how they are going to be trading with their European partners. And if you're an investor, that's certainly not the kind of environment that you would want to be putting your money in.
That sounds really tough, Juliana. But then how are the markets reacting to this at intraday?
I think there's still a little bit of positivity. Those gains at early trading have stayed and maintained at intraday. Deal or no deal Brexit is the topic of major concern. In fact, lawmakers in the House of Commons are debating Brexit right now. Sunday is D-Day, and I think there are a lot of hopes that perhaps a deal could be done. So at intraday, the all share is up 0.24%. The FTSE 100 is up by 0.48%, and the FTSE 250 is down by 0.36%. In currencies, the British pound down on the US dollar by 0.63%, also down on the euro by 0.82%, and down on the Japanese yen by 0.40%, Bissy.
Thank you, Juliana. We'll see you again tomorrow. In Asia, the markets traded mostly lower today as investors kept an eye on Brexit trade talks as well as ongoing negotiations in the U.S. for a coronavirus relief package. The Nikkei 225 in Japan fell 0.2%, while the Topix index was down 0.18%. In South Korea, the Kospi index fell 0.3%, and Hong Kong's Hang Seng index declined 0.56% in late afternoon trade. In Australia, the benchmark ASX 200 declined 0.6%, and China's mainland markets also struggled for gains as the Shanghai Composite was near flat and the Shenzhen Composite ticked up 0.12%. In the U.S., stock index futures moved slightly higher as investors continue to assess progress on additional stimulus measures as well as developments on the COVID-19 vaccine front. Futures contracts tied to the Dow Jones Industrial Average pointed to an opening rise of about 50 points, while S&P 500 futures and Nasdaq 100 futures also implied modest gains. Well, let's take a breather from those numbers now. In the markets, we head to Zimbabwe, where inflation rate eased to 401.66% in November year-on-year from 471.25% in October. Data from statistical agency Zimstats shows on a monthly basis, prices increased by 3.15% compared with 4.37% previously. Inflation has eroded savings and salaries this year, leading to strikes by public sector workers. But the National Treasury says inflation will moderate next year on better economic growth prospects. The board of the International Monetary Fund has completed the final reviews of Côte d'Ivoire's extended credit facility and extended fund facility arrangements, paving the way for an immediate disbursement of $278.2 million for the country. The 3-year ECF-EFF arrangements with a total access of about $896.7 million were approved by the IMF board in December 2016. In a statement released today, the IMF commenced the Ivorian government's response to the COVID shock by relaxing the fiscal stance to accommodate revenue setbacks. We'll be talking commodities when we return in just a moment. Do stay with us. Well, Welcome back. Nigeria is among the top global producers and exporters of sesame, with many years of very stable production. Now, our sesame contains relatively high oil content, which significantly promotes health benefits. But in spite of this, revenue currently generated from sesame exports is barely $192 million annually. Now, what can be done to change this narrative? Well, that's the question a research analyst at the financial derivatives company, Sheyi Omidiora, will be answering today on the domestic commodities segment. Good afternoon, Sheyi. Thank you for joining us on the program. Now, output and export of sesame has been mostly flat. What is responsible for this suboptimal performance?
Thank you very much. Now, sesame seed production is dominated by small-scale farmers who make up about 90% of the entire industry. Now, these small-scale farmers do not have access to education pertaining to sustainable farming methods. Now, as we know, water is a scarce commodity in the north, and this is also a constraint on irrigation farming. Now, with global warming and climate change happening, it's also affected the continent adversely. So, sesame seed production is needed. An increase in sesame seed production can be achieved if these farmers have access to sustainable farming methods, if they have access to the required education. Another possible reason for this suboptimal performance also has to do with the species of seeds being used in Nigeria. Now, a lot of research and development doesn't happen, and that will also impact the yields we have, since the quality of seeds being used aren't good enough.
Now, there are signals that Nigeria's land borders may be reopened soon. Do you think that this could be a threat or an opportunity for sesame producers in Nigeria, especially in the light of the signing of the AfCFTA agreement?
Okay, now it depends on what angle we are looking at this from. For exporters, we know that the price, the commodity is internationally traded and the price is benchmarked against the dollar. Most of our exports go to Southeast Asia, Middle East, and Europe. Now, a reopening of land borders will not or should not have so much of an impact on them. For local farmers, however, the case might be different. The NEPC said that sesame seed production in Nigeria is actually accounted for. Nigerian local farmers actually already take care of local demand. If the situation changes and we have an influx of sesame seeds into Nigeria, then it will have an effect on the profit margins of local farmers.
Sheyi, we know that sesame seeds are predominantly grown in the northern region of Nigeria, which has been affected by insecurity issues. But with the possibility of peace in these areas, do you think that the production of sesame seed will increase dramatically?
So if we begin to see a proliferation of peace in the north, what we expect is for farmers to return to their farms, seeing as there is a safer environment to working, and this should subsequently increase the production of sesame seeds.
All right, I'd like to thank you, research analyst at the FDC, Sheyi Omidiora. Thank you for your time on the program today. President Cyril Ramaphosa says that South Africa's 13.5% rebound in GDP during the third quarter of 2020 shows that a strong recovery is possible even as the economy remains below its pre-pandemic levels. Commenting on the Q3 data released this week by Stats SA this week, Ramaphosa says that GDP growth in the third quarter surpassed even the most optimistic market expectations. Let's see the report.
And second quarters of 2020 came with negative GDP figures thanks to the COVID-19 pandemic and the resultant lockdown restrictions. For Q3, there was cautious hope with the easing of lockdown regulations.
Our economy rose by 66.1%, seasonally adjusted, annualized. And when we look at the seasonally adjusted, not annualized, it rose by 13.5%. And it has recorded a negative growth 9 months on 9 months, sitting at negative 7.9%. And of course, year on year, sitting at negative 6.0%.
Despite the rebound, the economy is still 5.8% smaller than it was at the end of 2019. All industries recorded positive results in the third quarter. Agriculture and government are the only two that have so far weathered the effects of the pandemic.
It's good news. It's less of a contraction than had been anticipated. The real challenge, however, is to see how this recovery can be sustained. In the short term, there's no question the factors that contributed towards this recovery were a gradual lifting of lockdown restrictions over between May and September, as well as the fact that interest rates had come down by 3% from the beginning of the year through to September.
We obviously saw a good lift coming through from two sectors, the manufacturing sector and the mining sector. And of course, this reflects pent-up demand. You know, we obviously saw lockdown restrictions cutting off activity in South Africa in the second quarter. And of course, that caused that big collapse in GDP. We also, of course, saw some lift coming through from retail trade as well.
Economists say they welcome the government's efforts to revive the economy, but also insist that there's still a lot of work to be done in addressing structural issues, implementing policy reforms, and rooting out corruption.
South Africa is facing the economic reconstruction and recovery plan. We obviously have made some quite significant progress already in it. And both the progress that we have made to date and the fact that we are currently underway with some quite significant delivery on certain projects makes this plan more likely, in our view, to succeed than past plans of the decade that we have just been through.
Meanwhile, the South African rand has been strengthening this week, crossing to 14 rand 93 to the US dollar, close to levels not seen since February the 21st, after recent data showed the economy grew by an annualized 66.1% in the third quarter. President Cyril Ramaphosa has, however, warned that a second coronavirus wave in the country could derail recovery efforts.
And oil prices rose in early trade today, boosted by COVID-19 vaccine rollout in Britain and the imminent approval of a vaccine in the U.S., which could spur a rebound in fuel demand despite a large build in U.S. crude stocks last week. Brent crude futures climbed 0.4% to $49.07 a barrel, while U.S. WTI crude futures were up 0.5% to $45.75 a barrel. Vaccinations could start as soon as this weekend in the U.S., with a panel of advisors to meet today to discuss whether to recommend to the Food and Drug Administration emergency use authorization of the Pfizer-BioNTech vaccine. And that's our program today. Thank you for watching. I'm Bisi Adebayo.